Hi guys, today we are going to see Income Tax Inspector Exam 2023 Part 3. So before going into the video, kindly like, comment, share and subscribe for future videos. Question number 31. If annual value of the house property let out is negative, then the deduction under section 24 is allowed only for... So let's see the answer. The standard deduction of 30% under section 24A is not allowed. This is because the standard deduction is calculated as a percentage of the annual value, and 30% of a negative number would result in a further loss, which is not the intent of the tax law. However, the deduction for interest on borrowed capital under section 24B is still allowed, even if it results in or increases the loss from the house property. Therefore, the answer would be C, interest on money borrowed. Question number 32. Salary paid to partner by the firm is... So let's see the answers. Any salary or remuneration paid to a partner by their firm is taxable under the head Profit from Business and Profession and not as a salary income. This is because a partner is not an employee of the firm. Therefore, the answer would be B, taxable under the head Profit from Business and Profession. Question number 33. Mr. X is an employee in Accounts Department of A Limited. During financial year 22-23, the following transactions were undertaken by Mr. X. So let's see the options. First one is seminar fees paid by A Limited, amount Rs 12,500. So the tax treatment would be, this is considered as a tax-free perquisite as it's for the employee's professional development related to his employment. It is not taxable in the hands of Mr. X. Second option is tuition fee reimbursement for son, amount Rs 25,000. This is taxable perquisite. The entire amount reimbursed is added to Mr. X's taxable salary. 3. Daughter's education in company-owned school. Fees paid by Mr. X, Rs 750 per month. Cost of education in similar institution, Rs 5,250 per month. Therefore, the perquisite value will be Rs 4,500 per month. For the full year, 4,500 into 12 months, which is equal to 54,000. So the tax treatment would be difference between the cost of education in a similar institution and the amount actually paid by the employer is a taxable perquisite. So now let's calculate the total amount chargeable tax. So seminar fee is nil, tuition fee reimbursement 25,000, perquisite value of daughter's education Rs 54,000. So the answer would be Rs 79,000, which is D. Question number 34. Determine expected reasonable rent as per section 23(1)(a) of the house property with the following values. So, rules for determining expected reasonable rent. A. First we take the higher of municipal value and fair rent. Then we compare this value with the standard rent. The expected reasonable rent is the lower of these two figures. So, let's see the question. Higher of municipal value and fair rent is equal to municipal value is Rs 2,50,000, fair rent is Rs 2,85,000. Therefore, the higher value is Rs 2,85,000. Compare this with standard rent. Therefore, the standard rent is 2,70,000. Lower of the two is 2,70,000. Therefore, the expected reasonable rent as per section 23(1)(a) is Rs 2,70,000. Question number 35. An assessee is not entitled for deduction under section 36 of the IT Act 1961 for, first thing is bonus paid to employees. This is an entitled deduction. Interest paid in respect of capital borrowed for the purpose of business. This is also an entitled deduction. Provision for product warranties. See, provision for product warranty is not an entitled deduction. Why is because provision for product warranty is a liability account on a company's balance sheet that represents the estimated cost the company expects to incur for repair or replacement of products under warranty. So this will not be an entitled deduction. D. Premium paid to approver insurer is also an entitled deduction. So the answer would be C. Provision for product warranties. Question number 36. Which of the following conditions are not required for claiming the deduction under section 54 of the Income Tax Act? So let's see the conditions for section 54. The asset transferred should be a long-term capital asset. That is, it should be held for more than 24 months if it is an house property or more than 36 months for most other assets. The asset transferred should be a residential house property. 3. The asset should purchase another residential house. within 1 year before the date of transfer or within 2 years after the date of transfer, or construct a residential house within 3 years after the date of transfer. Therefore, in this case, the answer would be C. 1, 2 and 4 are correct. Question number 37. Which of the following is considered as transfer for charging of income under the head capital gains under section 45 of the IT Act 1961? So, in this case, D. Any transfer by way of conversion by the owner of a capital asset into or its treatment by him as stock in trade of a business carried on by him would be considered as a transfer. So, the answer would be D. Question number 38. Which of the following is not considered as transfer for charging of income under the capital gains under section 45 of the IT Act 1961? For in this question, A, B, C and D, all the above are not considered as transfer. So, therefore, the answer would be D, all of the above. Question number 39. Cost of acquisition of asset includes. So, the correct answer would be number 1, cost for which the previous owner of the property acquired it, cost of any improvement of the assets incurred or borne by the previous owner, cost of any improvement of the assets incurred or borne by the assessee. Therefore, the answer would be C. 1, 2 and 3 only. Question number 40. Capital gain is chargeable on any money or other assets received under an insurance from an insurer on account of damage to or destruction of any capital asset as a result of, in this case, 1, 2, 3, 4 all are covered under insurance. So, the answer would be D. 1, 2, 3, 4. Question number 41. If the assets of a company are distributed to its shareholders on its liquidation, can such distribution be regarded as transferred by the company for purpose of computation of capital gains? So, what is liquidation? Liquidation is a legal process in which company's existence is brought to an end. The company's assets are sold off and the proceeds are used to pay off debts and distribute any remaining funds to shareholders. According to section 46(1) of the Income Tax Act 1961, any distribution of assets by a company to its shareholders on its liquidation is not regarded as a transfer by the company for the purpose of capital gains. So, the answer would be B, shall not be regarded as transfer by the company. Question number 42. Where a company, not being a company in which the public are substantially interested, receives in any previous year from any person being a resident any consideration for issue of shares that exceeds the face value of such shares, the amount chargeable to income tax as income from other sources is, let's see option A. Option A is incorrect because it talks about consideration below fair market value, which is not taxable under this provision. Option C is incorrect because consideration equal to fair market value, which is not taxable. Option D is incorrect because it suggests reducing the fair market value from the consideration, which is not how the provision works. So, therefore, the answer would be only option B correctly describes the taxable amount, the excess of consideration received over the fair market value of the shares. So, the answer would be B. Question number 43. Index cost of acquisition means. So, let's see what is index cost of acquisition. It takes into account the cost inflation index for 2 specific years. The year in which the asset is transferred, B, the first year in which the asset was held by the assessee, or the financial year 2001 to 2002, whichever is later. The reference to April 1, 2001 is crucial because this date was introduced as a cutoff for considering the base year for indexation benefits, especially for long-term assets acquired before this date. So, the formula would be index cost of acquisition equal to cost of acquisition into CIA of the year of transfer by CIA of year of acquisition, or 2001 to whichever is later. So, the answer would be A1 only. Question number 44. While Finance Act 2023, the government has imposed a limit on deduction on long-term capital gain tax for reinvestment in residential properties under section 54 or 54F of the Income Tax Act. As per this amendment, which of the following statement is correct? So, the answer would be B. The deduction limit is up to rupees 10 crores and applicable from assessment year 24-25. Mr. X acquires 200 shares of a company on 1/5/2021 at rupees 50 each. On 9/11/2021, the company allotted bonus shares in the ratio 1:1. On 3/7/2022, Mr. X sells all his 400 shares at a price of rupees 250. In such a case, the capital gains would be, so the answer would be B, LTCG rupees 40,000 and STCG rupees 50,000. Guys, for this question I have made a separate video which would be in the playlist of concepts, where I would have explained step by step how to solve this problem. So you can watch that video and learn it. At the same time, this is the explanation for this question. Question number 46. As per section 57(1) of the IT Act 1961, a taxpayer can claim a deduction on account of interest expenses for earning dividend income. Interest on money borrowed for investing in the shares can be claimed as a deduction. However, there is a maximum limit, which is, so here the answer would be A, 20% of dividends or income in respect of units of a mutual fund. Question number 47. An agreement for sale of property was made on 29/11/2021 for a total consideration of rupees 70 lakhs to be paid on or before 31/3/2022. And towards earnest money, an amount of rupees 10,000 was paid on 29/11/2021. Earnest money means it is an advance payment done by the purchaser. The purchaser, however, could not pay the balance amount of rupees 60 lakhs before 31/3/2022. Consequently, the sale deed could not be executed. Seller therefore did not return the earnest money to the purchaser. In this situation, what will be the treatment of earnest money? So let's see. This option refers to as section 56(2) of the Income Tax Act 1961. This section deals with the taxation of forfeited advance money received in relation to negotiation for transfer of capital effort. According to this section, such forfeited amounts are taxable as income from other sources in the hands of the seller. So in this case, the seller, the amount of rupees 10 lakhs received by the seller would be treated as income from other sources. For the purchaser, the forfeited earnest money would typically be considered as a capital loss and not as a revenue loss. Okay, so here in this question, the answer would be D. Only A above is correct and B and C are incorrect. Question number 48. Mr. X purchased an asset in the year 1980 and invested rupees 2 lakhs in its improvement in 1980. Subsequently, he invested rupees 5 lakh in the year 2006 in its improvement. He sold the property in the year 2022. In order to determine cost of acquisition in this case, cost of improvement shall include, so let's see the answer. For assets acquired before April 1, 2001, the cost of acquisition is taken as either the actual cost or the fair market value as of April 1, 2001, whichever is higher. Any cost of improvement incurred before April 1, 2001 is ignored for calculation purpose. Only the cost of improvement incurred on or after April 1, 2001 is considered. Therefore, in this case, the answer would be B, rupees 5 lakhs. Question number 49. Which of the following statement is correct in relation to gift received at the time of marriage? See, gift received by an individual at the time of their marriage are completely exempt from income tax, regardless of the nature of the gift, let it be cash, movable property or immovable property or its value. This exemption is provided under section 56(2)(10) of the Income Tax Act 1961. There is no upper limit on the value of gifts received at the time of marriage that can be exempted from tax. Therefore, the answer would be A, there is no upper limit. With reference to section 64 of the IT Act 1961, which of the following statement is incorrect? In this case, the answer would be C. If both the parents of the minor child are not alive, then the income of minor child will be clubbed in the hands of the guardian of the minor child. So this is incorrect option. So the answer would be C. Thank you for watching the video, guys. Stay tuned for the next video.